Investing is easy, right? But why do so many investors fail? In this video, I'll go over 5 of the worst things any investor can do and how you can avoid them. It's your favorite investor, and this is the channel to help keep you invested in the markets and build your wealth. Now, one of the first things investors get wrong is thinking that they'll get rich overnight, right? They're gonna make this one investment and all of a sudden their fortunes have turned and they're just gonna be driving around that Lambo and they're gonna have all this attention, money, glory, all that. But I gotta tell you, man, this is not the way that investing works. And this especially happens with newer investors that are seeking cash, right? They're looking to get rich quick and they enter the markets with a short-term view and don't think in terms of creating wealth over time. They're not patient. The worst thing that an investor can do is be impatient and not allow the market to do its thing, right? Patience is something that we all lack at first. And I can tell you right now that any successful investor that has made a significant amount of money or built a significant amount of wealth in the stock market has developed that patience over time. They've allowed themselves to be patient and let their investments continue to grow and let the markets do its thing. The markets have a tendency to go up over time. So as long as you're patient and give yourself that time, you'll probably end up a lot wealthier. Another reason most investors fail is choosing the wrong investment vehicle. Early investors are impatient, so they don't want to invest in the boring old S&P 500 index. Why would they do that when they just saw this biotech stock that, literally launched to the moon over 200% just the other day? So, they'd rather just go ahead and invest in that as opposed to the S&P 500 because they have the opportunity of making 200% in one day. Who doesn't want that? But I'm gonna let you know, man, like that's not the stock that's gonna make you rich. A young investor is gonna be all over that. And I'm gonna let you guys know right now, I was that investor at one time. I was invested into these biotech stocks thinking that that was gonna change my life, and that was not the way. It wasn't until I finally started being patient, like I just said in my first point, and actually started investing into that S&P 500, and I noticed I started to keep a lot more of my capital. Not only was my capital there, it was continuing to grow. So make sure you pick those right investment vehicle. The S&P 500 is the benchmark, and what that's telling you is your baseline for return. So you want to try to aim for that baseline. Roughly 10% is what the S&P 500 is going to return to you year over year on average. This year we're above average. I think we're somewhere around 17%, but 10% is where you normally want to see your investments be. It's telling you, hey, a 10% return from the stock market year over year is pretty realistic. That's why you have that benchmark. Some ETFs or stocks are going to be, they're going to do better or worse. Something like XLK has about 18% year over year returns, and that's because it's pure technology. But you can see it's very far from that 200%. So you can't expect to see that 200% every single time year over year in the markets. It's just not going to happen. Your expectations have to be realistic. Now, before we get into the rest of this video, be sure to hit that like button and subscribe for more investing content. And be sure to check out our sponsor, thebestdividendcalculator.com. This is a free tool to help any investor plan out their financial journey. You can plan things out such as yearly contributions, reinvesting or not reinvesting dividends, or maybe you want to see how reinvesting dividends for 10 years and never investing again will look like. So there's a couple of different options out there. So make sure you guys head over to thebestdividendcalculator.com and start creating your plan today. Now let's get back to the video. Dividends are a beautiful thing. However, not reinvesting them, especially when you start investing, is a mistake. I think that is one of the biggest mistakes that investors can make, because dividends have accounted for 32% of the total return of the S&P 500 since 1926, right? Reinvesting your dividends allows you to purchase more shares without you having to front more capital. So what you're doing is basically multiplying your shares and building up that portfolio with the dividends that are being distributed from your company. Now, there is a huge misconception that people think that this is free money. It's not free money, because the share price does go down on the date that you receive that dividend. It usually recovers, and then you're able to use that cash and do whatever you need to. But there are some things that need to be talked about when we talk about dividends and how exactly they affect share price. That might be a future video, but anyways, in the beginning, your dividends will not be doing much. So reinvesting them into the fund and allowing them to continue to earn interest on the income that you didn't have to put in is one of the best things that you can do. So make sure whenever you get those payments that they're actually in a drip or a dividend reinvestment plan, so that they're continually being reinvested. You don't have to worry about going back in there and purchasing shares with that dividend. So make sure you guys are keeping that in mind. Another mistake is, listen, let's talk about this 401k, man. Many U.S. citizens have access or are receiving employee matches to their 401k, and this is phenomenal. But One thing is, you know, like people don't even realize that they're invested in the stock market. They don't know which funds they're invested in, or if the funds are even fully allocated. So they're not taking full advantage of that 401k and that employer match contribution. This is one of the biggest ways to build wealth. And I see a lot of people not even knowing, you know, where their 401k is held, how it's being held, what are they invested in, you know, did they even go in and look at and make sure that they're in the right funds. So it's one of those things where make sure you know what your 401k is doing, and make sure you look under the hood, and then on top of that, make sure you stay invested. So this actually ties into my last point really well, because most investors fail because they quit. And I see a lot of people going into their 401ks and they're pulling money out of their 401ks. They're young people and they're not using that to their full advantage. They're not allowing that compound interest effect to actually work for them in their favor, with literally money that they're getting from their employee to match their contributions. This is a phenomenal investment vehicle, but again, you're gonna fail if you quit. If you're pulling money out of your 401k, or you completely take your money out of the 401k, or you feel like your 401k isn't making money, you're losing money, my advice is to stay invested, right? Leaving your 401k alone, not going in and withdrawing from it, giving it time to compound and build up that interest. This is what you need to be doing, especially in your younger years. You know, people that are below 40, 30, you know, you're just getting your feet wet, you're just starting to work. Leave that money alone, let that money go in there and do what it needs to do. You can open up any chart, and even if you would have invested at the peak in 2019, looking forward to today, and you survived the COVID crash, you didn't sell out during the COVID crash, you stayed invested, and I'm telling you, you bought at the absolute peak of 2019, you would have still seen a 50% return on investment in 2023. So listen, man, don't quit. Keep your money invested. Make sure you guys are actively understanding what you're invested in. Go look at your 401ks, and just, you know, don't quit, man. Find the right investment, stay invested, reinvest your dividends, stay patient, and stay away from the biotechs, man. It's not worth it. Stay away from the biotechs. It's not worth it. But anyways, man, it's your favorite investor. I hope y'all got some useful information, and as always, I'll catch you on the next one. Peace.